Hi, I'm Christine Benz from Morningstar. I'm here live at the Money Show, and I'm thrilled to be joined today by Sam Stovall. He is the U.S. equity strategist for CFRA Research. Sam, thank you so much for being here.
Happy to be here, Christine.
Sam, one topic that I know is on a lot of investors' minds is they've got these allocations to foreign stocks in their portfolios, but they have not performed well relative to their U.S. holdings. And I know a lot of investors are kind of starting to give up the faith.
Oh, absolutely.
So let's talk about foreign stocks as a component of a portfolio. From where you sit, do they look attractive today?
Yes, they do. First off, people ask, why should I even have international exposure?
Right.
It's basically because 3/4 of global GDP is outside of the U.S. Also, more than 50% of revenues are for the large cap companies, the S&P 500, come from overseas operations. So to be fully diversified, you need to have some exposure to international. But also, international has been the pariah for the last 10 years. As a result, if you look at a rolling 5-year relative strength for developed international versus domestic U.S., they're trading at more than one standard deviation below the mean. So you should start hearing in your mind, reversion to the mean, reversion to the mean. And then if you look to the relative PE ratios, the valuations, it's not a value trap because earnings are expected to be up 11% in 2020 for developed international and 13% for emerging markets. So, but on a relative PE basis, they too are trading well below one standard deviation from the mean, implying that people are just ignoring them because they have not done well. So I would tend to say that if you have a longer term time horizon, that you don't want to be bailing out now on your international holdings, and you might actually want to start nibbling.
So revisit your allocation to foreign versus U.S. How about the emerging markets versus developed markets decision? How should investors play that? It sounds like you think potentially emerging markets might be a little bit cheaper, but of course you get extra volatility there.
You do get extra volatility, but a lot of the emerging market debt is priced in the U.S. dollars, but also in tagged to U.S. interest rates, et cetera. So with the Fed bringing down the value of our interest rates, and if we don't end up in a bear market environment that forces investors to flee to safety of the U.S. dollar, then maybe we could actually see international investments do well. From a technical perspective, our technicians say that there is a bearish bias to the U.S. dollar, and that would benefit all international stocks, but probably benefit the emerging markets more than the developed nations.
Okay, so that would also indicate there's been kind of a mania for some of the hedged foreign stock index funds. It sounds like maybe you think investors should just go unhedged. Sometimes you can bring your expense ratio down a little bit and fully experience currency changes and not try to get too cute about timing currency exposure.
Right. Well, the hedged ETFs, they offer an option for investors, but at the same time, what if you hedge the wrong way? What if you lock yourself in to a currency situation that, and then you miss out if it should move in your direction? So, by at least having international exposure in general, emerging market in particular, and basically remind yourself that you are a longer-term investor, then that could end up playing out quite well.
Okay, Sam, it's always great to get your perspective. Thank you so much for being here.
My pleasure. Thank you.
Thanks for watching. I'm Christine Benz, live from the Money Show.